Hi. In this video, I want to talk a little bit about algorithmic trading and introduce one very simple algorithm to automate your financial trades. So to begin, what is algorithmic trading? And here it's a style that uses computer software or algorithms to process historical data quickly and make decisions so that you can execute trades very quickly. This approach has always been based on hard data rather than forecast or opinion. It's always backwards looking, in other words. And one of the objectives of these algorithms is not necessarily to maximize profits under any condition, but also to control the execution costs and also to account for market risk. Some of the other advantages of algorithmic trading is that it takes away the human emotion from the equation. So once you program in the decision-making rules into your algorithm, human psychology or emotions will not sway your decision-making process as the market fluctuates. Here are some very common types of algorithms that are often used in algorithmic trading. Mean reversion, momentum strategy, statistical arbitrage, trend following strategies. I'll mention the first three briefly and describe them, and then we'll dig deeper into a trend following strategy. So what is mean reversion? Mean reversion exploits the tendency of a price to go back to the average after they've been overbought or oversold. So if you see a big fluctuate in the market, mean reversion theory postulates that the price will go back to some historical mean, and that's what it's trying to exploit. It does try to capitalize on extreme movements of securities, assuming that it does bounce back to its previous state. And one measure of this is the relative strength index. It's a commonly used indicator. There are other indicators out there, and I leave that up to you to look for. Another strategy is momentum strategy. And this is based on the assumption that the price of the financial instrument has some inertia. So if it's going in a direction, it'll keep on going in that direction, be it up or down. And it's usually used to capture moves in a short time frame. So if you see a surge in the price, you might want to jump on that bandwagon, or if you see a fall in the price, you might want to make the right decisions based on that. Momentum is also the acceleration in a stock's price due to earnings, statements, some sort of public news, and also human emotion like greed or fear. And they are a specific form of trend following strategy. Another class of automated trading algorithms is known as statistical arbitrage. And what this strategy tries to do is identify pricing discrepancies between different securities through mathematical modeling techniques. Generally speaking, the strategy is market neutral in that it it does involve a long and short position in different securities that are trying to offset each other in terms of their risk and expected return. The end objective is such that you want to generate a higher profit than normal profit for the investing firm or the trader. And another way to think about statistical arbitrage is that it is caused by some sort of exogenous shock in the marketplace, some sort of maybe news or a change in government policy, or if you're doing some sort of international investing, some sort of change in government regimes even, or dramatic changes in weather patterns, anything that might shift the distribution of the prices. And traders will try to take advantage of that. There are other algorithmic trading methods or classes of algorithms out there. And those are some of the common ones. You'll find many others. But the one I'd like to drill down in on is what's known as a trend following strategy. And the goal of this strategy is essentially to buy assets when the prices go up and sell the assets when the prices go down. But trying to time that will be based on historical data. And one of the most commonly used indicators is a moving average, which we studied earlier in this class. So so it's a great place to start thinking about algorithmic trading. One of the advantages of algorithmic trading is that we can test various scenarios, or we can calibrate our models using back testing as a trading strategy. And the idea here is to use historical data. We develop a model, and then we pretend as if we're going through time and testing our model and compare it to actual results. And hopefully by doing that, we should be able to calibrate our model to get a more efficient or a more effective trading strategy. So I think the best way to begin is to look at an example. On this graph, we have the prices of Apple stock from 2010 to recently in 2019. And here we can see a typical stock chart. Prices are trending upwards up until the mid 2015 or so, 2016. And then it drops around 2018, and then it's coming back up. And I'm sure you've seen this kind of data before. So what's the elements of this trading strategy? Basically, the strategy is a trends following strategy. So we're just going to follow the trends. And it works based on the historical movements of the moving average of the prices. We're going to compute what's known as a simple moving average. We've done this before over some period of days. And we're going to actually compute two moving averages. And one will be of a short time period, and one will be a long time period. And based on how these moving averages move together, or if they start to cross, that's where we know we have to make some sort of shift in our trading strategy. What we first need to consider is what's called a signal generator. So a trade signal is generated in this following manner in this algorithm. If the fast-moving average crosses the slow-moving average from below, so the short-term average suddenly spikes up and passes the long-term moving average, that's a buy opportunity, because in the short term the prices are going up, and that over the long term will also bring up the long-term moving average. The position once bought and sold will be held until there is another change in direction. When the signal goes from sell to buy, the assets are bought back, or more assets are bought.